Hello, this is Jo from Kepler Trust Intelligence. In today's video, we're going to provide you with a brief overview of Gold and Prospect Precious Metals, which has the ticker GPM. GPMs are London-listed investment trusts which invest in small-cap gold and other precious metals miners, and it's managed by Manulife's CQS Investment Management, a large global asset manager. So why might you consider investing in GPM? Well, we'll cover each of these points in more detail in a moment, but here's a quick summary. Gold provides diversification into a different asset class beyond equities and bonds, with the gold price recently hitting an all-time high. Gold miners can also offer differentiated returns to the gold price, with GPM achieving a 70% plus increase in NAV over the last 12 months compared to a 37% rise in the price of gold. GPM's flexibility to invest in small cap miners can also be a tailwind to returns relative to passive gold funds. And finally, the managers are bullish on the outlook for gold miners, with the high gold price starting to feed through to earnings and valuations. However, investors should bear in mind that the mining sector is highly volatile. Small caps can also be volatile, and GPM typically has gearing, which increases volatility. So let's start off by looking at the portfolio managers, who are Rob Crayford and Keith Watson. They've managed a trust for over 10 years and have multi-decade experience as analysts and investors in the mining sector. Rob and Keith also co-manage Geiger Counter, GCL, which invests in uranium miners, and CQS Natural Resources Growth and Income, CYN, which has a diversified remit across the mining sector. As a result, the managers have substantial in-depth sector expertise, as well as a high level of familiarity with management teams. So what's the principal investment objective of the trust? Well, it's to provide investors with capital growth from a portfolio of mining companies in the gold and precious metals sector. Rob and Keith take a highly active approach, focused on the smaller end of the market cap spectrum, and they use a combination of style factors but have a primary emphasis on identifying companies trading at a discount to their peers. They also look for high-quality management teams along with strong cash flow generation and balance sheets, meaning that companies can sustain profitability even if the spot prices of the underlying commodities fall. The investment trust structure allows them to take a proportionally higher exposure to developers and explorers and passive funds, together with attractively valued opportunities below the liquidity threshold of other funds. It also allows the use of gearing, which can augment returns to both the upside and the downside. Let's dig down into the portfolio, and I'd highly recommend GPM's monthly fact sheet, which provides an excellent insight into current portfolio weightings. Starting off with the underlying commodities, around 80% of the portfolio is invested in gold, which is well supported by a number of factors which we'll look at in more detail in a moment. Just over 10% of the portfolio is invested in silver, followed by 3% in each of the platinum and base metal groups. Moving to the type of holdings, producers account for the majority of the portfolio due to the highly cash generative nature of operational assets held by mature producers, with around 10% invested in developers and 13% in explorers. The managers believe that companies with one producing asset and growth on the horizon is the optimal time to invest, as a source of cash flow enables companies to control their own destiny and capitalise on a clear growth plan. Developers and explorers can provide an attractive risk-reward premium, but the managers take a cautious approach to pre-revenue companies, aiming to be the last money in before production, when the financing, engineering and design planning work is largely complete. Looking by geography, Rob and Keith have a global remit which offers exposure to parts of the world that investors may find difficult to access. This principally comprises companies listed in Canada and Australia due to their abundant natural resources, with smaller exposure to the US and the UK, although the managers will take country risks where appropriate, such as a Tier 2 or 3 jurisdiction with a Tier 1 asset due to the quicker permit times. Moving to the top 10 holdings, the managers aren't afraid to take high conviction positions, with the top 10 accounting for roughly 60% of the portfolio. However, it should be said that risk management remains a primary focus. Rob and Keith's in-depth experience of management teams enables them to filter the best prospects from the hundreds of manager meetings they conduct each year. They look for companies with attractive assets, good access to funding, robust business models and strong cash flows. As mentioned earlier, the trust has a small and mid-cap tilt, as these companies are not as well covered by analysts, offering the potential for alpha generation, and successful small caps are often acquired by their larger counterparts. By way of example, GPM had a top 10 position in Karora in July, which was acquired by Westgold at a 25% premium. There can also be a further boost to returns if companies grow sufficiently for inclusion in passive funds. On that note, I wanted to briefly touch on Ora Banda, an Australian mining company which currently accounts for around 9% of the portfolio. The shares have risen by more than 470% in the last year due to soaring gold production, and with a market cap of $1.7 billion, it looks on course to enter the ASX 300 index in the months ahead. So what are the main drivers of the gold price? Well, the price of gold has soared to record highs in recent months, and a key driver has been the volume of purchases by central banks following the Russian invasion of Ukraine. Demand has been particularly strong in emerging markets due to longer-term strategic geopolitical motivations, as central banks look to diversify away from US dollar assets due to the risk of sanctions. Against a backdrop of elevated geopolitical tension, gold is also benefiting from its perceived safe haven status for retail investors, as well as being a possible hedge against inflation. And there's been particularly strong demand from retail investors in China as well as India, where a burgeoning middle class is driving demand for gold as a store of wealth. However, there's been a noticeable divergence between gold mining equities and the underlying gold price in recent years, partly due to inflationary cost increases. On the revenue side, falling interest rates should in theory support the gold price by reducing the opportunity cost of holding gold over cash. However, this is dependent on a return to the traditional inverse correlation after a period where both interest rates and gold prices rose. Combined with falling cost inflation, this provides the potential for margin improvement going forward. We have seen a decent rally in the past 6 months, although the managers believe this is due to a slight recovery in the large underweights in an out-of-favour sector, rather than reflecting the upside potential in margins. As a result, miners remain cheap versus their own history and also their typical trading range versus gold. Moving briefly onto the silver price, this has also risen strongly and is approaching its record high of 2011. As with gold, silver is in demand as a store of wealth, but is also a good diversifier due to its industrial demand in computer chips, solar panels and wind turbines, amongst other things. The silver price is supported by supply constraints, with the largest producer, Mexico, set to ban open pit mining, as well as sanctions on Russian exports. However, the managers believe that valuations are less attractive than in the gold space, hence a lower allocation in GPM's portfolio. Turning to performance, this graph illustrates the exceptional returns achieved by GPM in the right conditions, including 60% plus returns in 2019 and 20, and 100% plus return in 2016. This was followed by a rough period of negative returns from 2021 to 2023. Expectations of higher interest rates weighed on the price of gold and gold miners in 2021, followed by divergence between rising gold prices and mining equities. As you can see, performance has been very strong in the last year, with NAV and share price returns of 51% and 68% respectively. Given the record gold prices and the easing of inflationary cost pressures, the managers believe that improving profit margins should be supportive for returns. In addition, the attractive cash-generative nature of miners could drive further M&A activity as mature producers look to bolster their reserves. Before we leave the topic of returns, GPM has never paid a dividend, and income is not likely to become a part of the investment mandate. However, the board has noted that it would consider paying a dividend if net income becomes significant. So what about the trust discount? Well, at the time recording, this is just under 20%. It's typically ranged from around 10% to 22% over the last 5 years, so the current discount is towards the upper end of this range. However, if sentiment towards gold miners improves, the discount could provide a kicker to returns, as we saw in early 2020 when the discount narrowed close to par. The board is committed to narrowing the discount and has increased marketing spend to that end, appointing a new PR firm and a non-executive director with a background in investor relations and marketing. The board has the ability to buy back shares, but hasn't done so in recent years due to the negative impact on both liquidity and fees. In terms of gearing, this has typically ranged from 8% to 12%. It's currently just under 10%, and we think this should be seen as a positive sign for the trust due to the attractively valued opportunities that Rob and Keith are identifying. One of the disadvantages of being a small trust is the ongoing charges figure, the OCF, which was 2.22% at the time of recording, although this should continue to fall if the trust performs well. The OCF includes a management fee of 1.25% of NAV on the first 20 million of assets and 1% on anything above this. GPM also has an annual subscription rights programme with the aim of growing the fund, giving shareholders the right to subscribe for new shares in a 1:5 ratio, and if taken up, this would reduce the fee burden per share. If you'd like to find out more about GPM, please head over to the KTI website where you'll find our latest research note together with other articles on the trust. You can also find further information on the GPM website, including their latest fact sheet and the recent articles by managers. So on that note, have a good day, and we hope you join us again soon.